Let's talk about IRS Form 1040, Underpayment of Estimated Tax this year. So if you're in a similar situation, I want you to listen till the end because you're going to learn a lot of gems here. I'll be spilling all the beans you need to make sure you understand Form 1040, Underpayment of Estimated Taxes. Don't you go anywhere. You're going to love today's conversation. I guarantee you. Welcome back, folks, to another edition of the Awesome Sweaty Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as great and blessed as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's conversation, I want to speak about IRS Form 1040, Underpayment of Estimated Tax. And it's important to understand that. Let me just first give you an overview. So when you think about the U.S. tax system, you have to think about a pay-as-you-go system. In other words, you are usually required to make tax payments as you earn income. If you don't, you do have a penalty for late estimated tax payments. So you should make estimated quarterly payments if either of these applies to you. Let's say your employer does not withhold taxes from your paycheck. Your withholding does not cover all of your income, okay? And so those are the two options where you have to make estimated quarterly payments. So estimated tax payments, they are due on April 15th, June 15th, September 15th, and January 15th of the following year. So this is really important. Now, those dates are static, but if any of those days falls on a weekend or holiday, your payments is due on the next business day instead, okay? So this is really important. So when we talk about estimated tax payments, those are made each quarter, and you have to send the cash to the IRS, okay? And so when people earn income, whether through wages, interest, and dividends or rents, they have to pay taxes on it. And regular employees, in other words, the 9-to-5 employees, they automatically have their taxes withheld from their paychecks and submitted to the IRS by their employer. But self-employed people and business owners have to estimate how much tax they owe and pay it themselves. Okay, so this is really important. So when we talk about your estimated tax, we have to talk about your tax liability. And the IRS estimates someone's tax liability for the year by looking at what he or she owed last year. So according to the IRS's tax code, an individual has to make an estimated tax payments if he or she is self-employed and expects to incur a $1,000 tax liability for that year, or if his or her earnings stem from ownership of a corporation or a partnership in one of the several states. Okay, and this is really important. So the IRS has specific rules in place, and so when we talk about, let me give you an example. Let's say Leslie is a freelance reporter, and her employment status is independent contractor. So the newspapers she writes for do not withhold taxes from her pay. Okay, because she made about 30 grand last year, she estimated that she will make about $35,000 this year, meaning that she expects her tax burden to exceed the $1,000 threshold that requires her to make estimated tax payments. So each quarter, she sends a percentage of her income to the IRS based on her understanding of the marginal tax rate she falls into. When she files her yearly tax return, she will actually if she finds that she overpaid a little, the IRS will send her a refund for the overpaid amount. Let's really clarify a few definitions. Really important. There are a lot of concepts, and it's important that folks understand really what we're talking about. So let's talk about underpayment penalty. Let's just define that. A tax penalty is enacted on an individual for not paying enough of his or her total estimated tax and withholding. And what happens here is that if an individual has an underpayment of estimated tax, he or she may be required to pay a penalty. Now, there is a form. That form is 2210. So Form 2210, as you can see on the screen, this form is used to report the payment. Okay, now let's just break down the underpayment penalty. So to avoid an underpayment penalty, individuals must pay either 100% of last year's tax or 90% of this year's tax by combining estimated and withholding taxes. The underpayment penalty is owed when a taxpayer underpays his or her estimated taxes or makes uneven payments during the year. So IRS Form 2210 that I just showed you earlier is used to calculate the amount of taxes owed, subtracting the amount already paid in estimated taxes through the year. If the taxpayer realizes that he or she underpaid, he or she must pay the difference plus a penalty, which is calculated based on the outstanding amount owed and how long the amount has been overdue. So the IRS really must make sure that they do not want to encourage underpayment. So typically the penalty is 0.5% of the amount owed for each month of non-payments. Not all underpaying taxpayers face a penalty payment though. Okay, so because that penalty may be waived under several scenarios, including a taxpayer's total tax liability is less than $1,000, the taxpayer did not owe any taxes for the previous year, the taxpayer paid at least 90% of the taxes owed, the taxpayer missed a required payment because of a casualty event, disaster, or other unusual circumstance, the taxpayer retired after reaching age 62, the taxpayer became disabled during the tax year or during the preceding tax year for which estimated tax payments were unfulfilled, any other situations where the underpayment was a result of a reasonable cause and not willful neglect. Okay, so those who do not qualify for the exception mentioned earlier to the underpayment penalty may nonetheless qualify for a reduced penalty in some situations. For example, an individual who shifts his or her tax filing status to or from single to married filing jointly may be afforded a reduced penalty. A reduction might also be extended to taxpayers who generate significant portion of their income late in the calendar year. So one such example is an investment holding that sold off in December, thereby triggering a substantial capital gains tax. Okay, so this is really important. So let's talk about the tax penalties. I mean, there is a constellation of penalties that you really need to be aware of. So you have the late estimated tax payment penalties. So when dealing with if you missed your estimated tax penalties, you need to include any payments made after its due date in the total amount paid during the next quarter. Example, if your second quarter payments was due, let's say June 15th of this year, and you paid it 2 weeks after the due date, the thing is that the IRS will consider the payment made in the third quarter. So you will get a notice from the IRS informing you of any estimated tax penalties and fees, okay? And what about underpayment of estimated taxes? So you might pay an underpayment penalty if both of this applies to you. You don't make estimated tax payments during the year, and the amount you have withheld from other income is less than 90% of your tax bill. So to avoid an underpayment penalty, you want to make estimated tax payments if you have self-employment income. If you have other income that taxes were not withheld from, you also need to put some cash on the side, okay? And so the IRS uses this system to figure your penalty for late estimated tax payments. So when you file, let's say when you file your return, the IRS will calculate how much tax you should have paid each quarter. And so they have like an algorithm. Everything is done automatically. So there's nobody at the IRS that does this calculations manually anymore. They used to, but they don't do it anymore. So what will happen here is that the IRS will apply a percentage, quote unquote, the penalty rate, to figure your penalty amount for each quarter. And the penalty amount for each quarter is totaled to come up with the underpayment and penalty, the underpayment penalty that you owe. Okay, so this is important. Now, if you already underpaid your tax, one of your options is to let the IRS calculate your penalty. You can let the IRS figure your penalty if you did not withhold enough tax by the end of the year, the exceptions don't apply to you, and you did not file Form 2210. Okay, and it usually will not cost more to have the IRS figure the penalty if you pay the amount due by the date specified on the IRS bill. In certain cases, based on what we have seen, you might have to file Form 2210. It really depends on the state. It depends on your financial situation and your tax status for this year. let's dig a little deeper. I want to dig a little deeper into the exemptions because there are cases where there is no penalty here. Okay, now when the penalty does not apply. So remember, the IRS is trying to be fair to all taxpayers, and so that's the mandate that Congress has handed over to the IRS. So the agency will not assess a penalty. They will not levy a penalty if certain exceptions apply. So if you qualify for an exception, estimated tax payments are not the same as withholding. So there are exceptions to the penalty and situations where the penalty would not apply, including the total of your withholding and estimated quarterly tax payments was at least as much as your prior year tax. Number one, you had no tax liability last year, and you were a U.S. citizen or resident alien for the whole year. It has to be the whole year. You owed some tax last year, and you had that amount or more of tax withheld from your paycheck this year. And however, and this is a big however, if your adjusted gross income happens to be more than $150,000 or $75,000 if married filing separately, you must pay at least 110% of last year's tax. Okay, and so another exemption is if you had at least 90% of this year's tax withheld from your paychecks. Another exemption is if the amount you owe this year is greater than your withholding by no more than $1,000. And another exemption is if you did not have any withholding taxes and your last year tax is less than $1,000. So you can see that you have actually a constellation of exemptions, and it's very important for you to see in which exemption, quote unquote exemption, you fall into, so that you can actually avoid the penalty. And this is kind of important because in some cases, your lawyer or yourself might want to fight any penalty that the IRS is levying on you. So you need to go back to the list that I just gave you and say, listen, where do I fit in, if at all? How do I qualify so that I can actually avoid being penalized by the IRS? So this will require a little bit of research, but it is totally possible. There are exemptions out there. And if you have questions, please feel free to email us, and we'll certainly dig a little deeper and answer you. Let's talk about no penalty. So there are ways to lower or eliminate the penalty. This is important to really understand. So the thing is that if the exceptions do not apply to you, you still might reduce the penalty you owe or avoid the penalty altogether. Okay, but everything starts with a quintessential form that I just shared with you earlier. And that form is what? 2010-2210. So you want to file Form 2210, not 2010, 2210. So you want to file Form 2210 if any of this applies to you. If any of this apply to you, yes. So your estimated quarterly payments were adequate and timely for your tax situation. For example, you owed 20 grand in tax and you paid 5 grand every quarter. If you generated a large part of your income later in the year, so let's say you sold an investment in December and generated a capital gain, and so you need to pay capital gains tax. A large part of your tax payments occurred earlier in the year. For example, you applied a large overpayments from last year's return to this year's taxes. If your filing status has changed to or from married filing jointly, so if you're married this year and both filed as single last year, you can usually combine last year's tax on your return and last year's tax on your spouse's return. Okay, this is important. And if you're interested, you want to learn more about this topic, please, you can go to the publication 505, that's tax withholding and estimated tax, okay? Or you can go to Form 2210 to learn more. If you are a farmer or a fisherman and your withholding plus quarterly estimated tax payments are at least 2/3 of your last year's tax, you can eliminate or lower your penalty. If a casualty or disaster occurred, making it unfair for the IRS to impose the penalty, this is really important also, or you are retired or disabled and your underpayment was due to a reasonable cause instead of willful neglect, okay? But the thing is, in both cases, in the case of retirement or casualty, you want to attach a statement to your return explaining what caused the underpayment. So this is called an explanatory note, explanatory note, not rote, note, and you basically explain to the IRS what really happened and why what happened is affecting you now. I'll be right back. Right after this, don't go anywhere. Welcome back, folks, to another session of the Awesome Sweetie Kiwi Show. We're also having a conversation about Form 1040, Underpayment of Estimated Tax, and let's talk about the appeal, because basically the IRS might actually impose the penalty, but what if you disagree? If you disagree with the IRS, then there are a lot of things you can do. Okay, so basically the IRS will send you a notice, and that's the notice that actually talks about the fees and you know how much they're charging you, and so basically the IRS will explain, the notice they send you will explain your appeal rights if you disagree with the penalty IRS has proposed. So if you disagree, you must first notify the IRS supervisor within 30 days by completing Form 12009. So 12009. So this is called a request for an informal conference and appeals review. So you got to contact the supervisor, really important. If you are unable to resolve the issue with a supervisor, you may request that your case be forwarded to the appeals office. And the thing is, don't forget, you have 30 days from the date that the supervisor notifies you, then your case cannot be resolved at that level to request an appeal. Okay? And the appeals office is separate from and independent of the IRS office that proposed the penalty in the first place. And appeals office reviews are conducted in an informal manner by correspondence, telephone, or at a personal conference. Okay, and the thing is that ideally, and this is what we have seen in our experience, ideally, most differences are settled in appeals without expensive and time-consuming court trials. And appeals will consider any reason you have for disagreeing, except for moral, religious, political, constitutional, conscientious objection, or similar grounds. You may represent yourself in appeals, or if you wish, be represented by someone. So the person you choose to represent you must be an attorney, a certified public accountant, or an enrolled agent authorized to practice before the IRS. And if you plan to have your representative talk to the IRS in your absence, you must provide a properly completed Form 2848, Power of Attorney and Declaration of Representative. Okay. If the matter is not resolved in appeals, the IRS will send you a notice of the penalty amount due. If you disagree, you must first pay the total amount due and file a claim for refund on Form 843. And if the claim is rejected, or if the IRS does not take action on the claim within 6 months after the date you file the claim, you may proceed to litigate in either the U.S. District Court or the U.S. Court of Federal Claims. It's very important. And there is also another thing that's, sometimes you don't have to litigate. I mean, you can try to find relief. Actually, there are several ways to seek penalty relief. Okay, and do not pay the IRS penalty without looking into penalty relief first. Remember, the IRS does not abate the vast majority of penalties. Why? Because people don't know how to ask for penalty relief, or it may seem like it's not worth the time or effort. Okay, now it's totally worth it. It is totally worth it. Now you have to understand, the IRS uses penalties to encourage all of us taxpayers to follow the rules and remain in compliance, and it uses them a lot. So each year the IRS actually levies levy tens of millions of dollars in penalties. Okay, and those penalties, not dollars, tens of millions of penalties, and those penalties total billions of dollars. But the IRS also provides several options to get penalties removed or abated for people who qualify. Okay, so the most common IRS penalties are for not filing and not paying. So there are almost 150 penalties in the Internal Revenue Code, but a few common penalties make up 74% of all penalties. Think about that. 74%, that's like close to 3/4. Okay. And so the most common penalties are failure to pay penalty. So 56% of all penalties imposed if you don't pay taxes on time. You have failure to file penalty. 14% of all penalties imposed if you don't file a return on time. And you have a failure to deposit penalty. So 4% of all penalties imposed if a business does not pay employment taxes on time or pays them incorrectly. So you have to understand. Now, what I want to say here is that a frequently encountered nuisance penalty is the late filing penalty for partnerships and S corporations. So the estimated tax penalty is another common penalty that taxpayers often dispute by providing an exception when filing their tax returns. Okay, so this is really important. Now, there are several reasons why the IRS might remove penalties. Statutory exception. In other words, you can prove that a specific authoritative exclusion to the penalty. Or the IRS errors. So documenting that the error was the result of reliance on IRS advice. Or reasonable cause, providing a valid reason that you couldn't comply based on your facts and circumstances. And number 4, administrative waiver, taking advantage of a provision that facilitates effective tax administration. Thank you so much for your attention. I really appreciate it. In today's conversation, just want to quickly recap here. Today's conversation, I was talking to you about IRS Form 1040, Underpayment of Estimated Tax. So I gave you an overview, and I spoke about the definition, tax penalties, exemptions, no penalty tax, appeal, and penalty relief. Thank you so much. I will speak to you another time, but until then, remember, stay marvelous.